Welcome to our VR Mergers and Acquisitions Business Brokers of Charlotte's February webinar. Super excited about our guest today, David Teacock, an attorney, and Scott Berkner with Dogwood State Bank, who is, as he just said, having some technical difficulties here. But we're gonna jump right in. Before we do, I want to pull up our presentation here for everybody. So you guys can follow along here. And while you can't see Scott, there's what he looks like in the top, and David is there in the middle. And if I could, David, will you give a brief introduction about yourself, and Scott, you can follow him.
Yeah, sure. Thanks, Adam. My name is David Teacock, and I am a business and transactional attorney. And what does that mean in more specifics? It is I practice pretty much the majority of my practice. I'd say 60 to 70% of my practice is in kind of the mergers and acquisition space for small businesses. And what I consider a small business is kind of a transaction value of under about $10 million. And most of my clients that I help in that kind of transactional space, my usual kind of sweet spot runs from probably about a $500,000 transaction to about $5 million. And that's probably the majority of my transactional practice. Then the rest of my business, a third to 30% of my business is kind of corporate outside counsel work, right? So anything from helping people start their businesses to employment contracts and client agreements. So that is kind of primarily where I handle most of my business. So it's kind of getting people maybe from the start of a business all the way through the life cycle of selling a business or coming into buying a business and continuing with them through that life cycle of the business as they go forward. That's it. So I kind of work with brokers, buy side for buy side clients, sell side clients, and then clients who are kind of getting their business ready or with the intent to potentially sell in a couple of years, start prepping them and getting them ready so they can sell their business in an efficient and effective way.
Great. Well, thank you, David. And Scott, you look really young on the picture on the screen here. You want to provide a little bit of background on yourself, and then we'll jump in.
Sure, Adam, will do. Sorry, everyone, for the video snafu, but yeah, my picture probably looks a lot better than what I look like in person. I'm Scott Berkner. I'm a SBA lending specialist for Dogwood State Bank. We are a small bank here headquartered in North Carolina, but our SBA group, we have the capacity to do loans in all 50 states, so we're a fairly large SBA lender. I've been an SBA lender now for going on 25 years. All I do for the bank. We focus on business acquisitions, partner buyouts, startup businesses, real estate, really anything that could be eligible through the SBA program.
Great. Thanks, Scott. And real quickly, my name's Adam Petroff. I'm the managing partner of VR Mergers and Acquisitions here in Charlotte, focusing on the 1 to 10, upwards to $15 million market, working with sellers who are looking to maximize their value when they're ready. So, brief introductions. The title is pretty simple and straightforward. What's going on in the transaction marketplace? And so we're going to jump into that. But before we do that, I want to give you a disclaimer here. Everything we're talking about is general information. David's not giving specific legal advice. Scott's not giving specific lending advice. These are general terms, things that are going on in the market right now. And this is what we're going to talk about today. This is the overview. We're going to talk about what's going on in 2023. We're going to talk about it from a lender's perspective. We're going to talk about it from an attorney's perspective. We're going to talk about it from a broker's perspective. We're going to have a summary and also provide some questions. So questions, if you have any questions, feel free to put them in the Q&A or the chat section, and I'll do my best to accommodate them as they come in. I'll try to filter them in, combination of watching the video, and I may miss it, but happy to address your specific questions. And so let's jump in. Just at a high level, what the number one thing that we would all like to convey is a little bit of a mixed message. Deals are absolutely getting done. We are all super busy, but it's 2023 and things have changed. And so we're going to touch on some of these here, and then we're going to let David and Scott dig into them. Obviously, interest rates have increased over the last 6-9 months. Sellers' expectations, they're still assuming it's going to be a quick and easy deal. In some cases it may be, but there's a little more involved in deals than there was maybe 12, 18, 24 months ago. Buyers' expectations and what we're seeing out of buyers is that just like the housing market, first-time buyers are absolutely more cautious right now. And there's a mistake going on, in my opinion, and from many brokers that I speak with across the country, that because interest rates have gone up, that buyers are assuming it's all of a sudden a buyer's market. And I hate to be the bearer of bad news. It's not. I'm not saying it's 100% a seller's market, but it is not a buyer's market, maybe on the smaller side of the deals. And we'll get into that in a little bit later. Longer due diligence periods, and then all three of us are advisors that work on deals, as well as with CPAs and insurance folks and financial advisors. And we would argue that at this time, advisors are more important than ever. Before we jump into some specifics, David or Scott, anything you want to address on this, or we can dig into it when we get into your specific section? David?
No, I think we're good to jump into it at a later point. Although I will reiterate, yes, I mean, the main thing is deals are getting done, and you're still kind of seeing, in my opinion, a pretty significant kind of flow of business and deals and possibilities that are out there. We'll get into it in more detail, what that means. But yes, I mean, I still see, I'll hear a couple a week come through that say, hey, I want to buy a business, or I want to sell my business, or we have someone interested. So, regardless of whatever the economics is, there's still supply and demand out there in the marketplace.
Scott, anything you want to add, or should we jump right into it?
I think we're good to jump right into it.
Well, let's do that, because we're going to jump in from a lender's perspective here. And so, Scott, I'm going to let you take over here and sort of talk about some of the things that you're seeing, followed by David, and then I'll take it from the broker's perspective. So go ahead, Scott.
Sounds good. Well, I guess just to reiterate what both of you gentlemen have said is deals are getting done, right? We're extremely busy. I know a lot of other peer lenders are very busy. A lot of transactions are coming in. A lot of people still wanting to move forward and purchase a business and fulfill that dream. So we are actively busy and working on those on a daily basis. So things are getting done, contrary to what you hear maybe out in the markets. You guys have any additional comments on that, or I think you've already touched on that?
Yep, go right ahead.
Adam said it earlier, interest rates, right? It's been on everybody's top of mind. Part of that, I think, is, the biggest reason that I think there's a lot of questions about the interest rates, as they increased very rapidly. The prime rate escalated from 3.25 to 7.75 at a record pace. I've been in this industry a long time, haven't seen it increase that quickly. But recently, it seemed to become secondary, not the first question that a customer might have on their mind. It's now become more the focus is on the value of the business and the long-term focus on that business performance, not just today's interest rate. So it's, I think we've kind of settled in. The SBA loans are typically variable rate, so in most cases, the rate is going to decrease over time, and that's obviously controlled by the Federal Reserve. But that's just some of the comments they've made as we get to the end of 23 that things might ease again. So they'll have the benefit of the rates decreasing as well. You guys have any additional commentary on that?
I would just say if you're buying a business today and you're at an elevated rate, assuming it's going to go down, which most people think, if it can survive at these rates, it's only going to improve going forward. So if you're stress testing a deal and it makes sense at these elevated rates, it's only going to get better.
Sure.
Go ahead, Scott.
Dave? Yeah, sure. So next thing I think I really want to touch on is that the sellers, in most cases, have not adjusted their prices for the sale to the higher interest rates or higher cost of goods that is going to apply to the new buyer. So when a transaction comes in, that's one of the things we're really looking at now, not just the current financial status of the business and the projections that the buyer will put together for the business, which is a requirement, but were there any other adjustments in there for a 20 to 30% increase in cost of goods? Has that been taken into consideration prior to the lender underwriting the loan, committing, ordering a third-party valuation to find out there may not have been some adjustments in those? That's something that definitely it's been a topic of conversation here at our bank and on deals that are coming into me. So just wanted to touch on that subject a little bit. Adam, do you have anything else from your side?
Yeah, no, I think you're hitting on a huge issue. I mean, this is an example of if you're looking back 3 years, 3 years ago's financials are less relevant to a bank and to a buyer than obviously the trailing 12 months. And because 3 years ago we weren't dealing with this, so everyone wants to see the last 3 years, and now as we're at the end of we're in 2023, very few people are even looking at 2020 or 2019. It's really 21 and 22. So that's a big change. And some of these inflationary things were not even relevant in early 21. And so we're seeing it on the valuation side that valuators are really just looking at 22 and 21. And obviously the banks are. So go ahead, Scott.
Yeah, I'd agree. Those cost of goods, I mean, there just needs to be some adjustments made to the existing financials for things like leases, employee costs, other business expenses. In some cases, they've increased 20 to 40%. And so that just needs to be taken into consideration as we're working through these transactions. To kind of segue into the next bullet point is leases, right? So when we're looking at a transition to business, if it's a leased property, I advise that we get way ahead of that now more than ever. So can that lease be renewed? Is the landlord going to be open to the new buyer coming into a space that maybe the tenant's been in there 20 years and they have a great relationship? There's just, will the landlord provide the necessary items to close your loan? So a couple of those things are what we call a landlord waiver and an assignment of that lease to the bank. All right. So it gives the bank the rights to our collateral that we might have in the business, but it also gives us the right to continue that lease until the bank might want to exit that business if the loan was in default. These things just need to be factored in when we're working on these deals. And that's more of the projection side, is looking at, if they can't currently lease that space, they have to move the business. What's the cost of doing that? Can it be done easily? What does that new lease look like? So those are just forward looking, but now more than ever, I'm seeing significant holdups in our closings regarding the lease and getting landlords comfortable. In most cases, your SBA loan for an acquisition is going to be a 10-year term. and the SBA, including the bank, is going to require that the lease term match the term of our loan. Now, it doesn't have to be a straight 10-year lease. It could be a 1-year lease with 9 renewable options. But in that document, it has to say that you as a client can remain in that space for 10 years, which is the term of the SBA loan. And that's for all SBA lenders in the country. So those are just some things that we're seeing recently that are holding up our closings and just pushing those timelines that we all want to adhere to get these done out further and further. So any comments from you guys?
No, lease, and I think you're going to address types of financing and seller financing. We already have a question in, so let me read the question, and then you can address it, because I think you're going to touch on this. And it's, are sellers having to take on more seller financing to get deals done with higher interest rates? If so, how are sellers responding? So I think you're going to touch on seller financing, and there's a question leading right into it. So go for it, Scott.
Sure. Yeah, so we are seeing more seller financing in a lot of the requests that are coming through. Sellers in some cases might need to take a larger seller note, or potentially there needs to be a lower purchase price, right? So they probably would look to go to a seller note. So what does that mean? In the lender's eyes and SBA's eyes, as a preferred lender, there's 2 types of seller notes in my mind. So the first note could be if the seller is helping you as a buyer meet the equity injection requirement, which is a cash injection to purchase a business, which the minimum for SBA standards is 10%. But SBA would allow you to do a 5% cash injection from you as the buyer if the seller was willing to do a 5% standby note. Now, that note needs to be on standby for the entire term of the SBA loan, which is 10 years. So there can be an interest rate tied to it, and the interest can accrue, but the interest or principal cannot be paid out if the seller note is treated as equity to get to your 10%. In addition to that, though, now we are starting to see more and more where lenders are trying to minimize risk, right? Our unsecured goodwill portion of these transactions. And so on a case-by-case basis, we may, or other lenders may, require an additional seller note. Now, that just really strengthens the deal, and it's a negotiation. But that additional note could have terms. And what do I mean by that? Terms could be you can agree on an interest rate right now. You can agree on making principal and interest payments right after the closing, 30 days later. You could push that out for a number of years. Those things are negotiable between you and the seller to get there. But as a lender, we see that as a strength of the deal. It's reducing our loan, it's reducing our risk, it's reducing our unsecured collateral position of the SBA loan. And in some cases, it's needed. Any comments from your side, Adam?
I just want to add, for those of you out here, and I'm sure we have some buyers on this call or this webinar or watching at a later date. That doesn't mean that seller financing is going to 50, 60, 70%. What it means is deals that were going with 0 seller financing may be getting 10, maybe 15, or some that we're doing 10 might be going 15 to 20. But it's not going from 0 to 70%. So, but it has increased. It's a way of diminishing the risk of the bank, as Scott mentioned. It also gives the buyer greater comfort. And if the seller is willing to do the seller financing, then that is signaling to the buyer of their confidence in the business going forward, which is definitely healthy. So moving on, past seller financing, Scott, what else are you guys seeing out there?
Well, one topic, and customers always want to know the timeline. What's the process?
We lost Scott. Okay, well, Scott will join in. The good thing is David and I are prepared when Scott joins us. We've never had that happen before, but we did just lose him. We're going to switch over to an attorney's perspective. We'll bring back Scott on here in a minute. So David, just like any good advisor, you're ready to go on a second's notice. What are you seeing out here from a lender? Excuse me, from an attorney, when you're talking with buyers and sellers, as we're in 2023, I know we worked on a lot of deals last year and working on some again this year. What are you seeing that's changed, or something that buyers and sellers need to be aware of?
Sure. Just and just to kind of hit on some of those points that Scott had made, the financing, to your point, Adam, where you said, it's not 50 or 60. I mean, it's funny. There, I did have a deal where, and this was kind of end of 22, when it was probably a little bit more, when it was a little bit more kind of unknown, that I did have a potential buyer go in, and they were basically, the bank was proposing a 60% type of financing situation. But from my perspective, that's kind of fallen off as we've gone into 2023. There is, I have a current deal that's trying to kind of close up. And to Scott's point, there are actually there's two seller financing notes out there. There's one that's about 5% of the deal price is that full standby, and then one's getting paid, kind of concurrently with that SBA note as it starts. And to that point, that's something you just didn't see, in 2020 or 2021, when the rates were low. You didn't see, we almost went 2 years where you didn't see a ton of seller notes, period, right? And I think this is actually getting back to kind of where it was prior to the pandemic, where, a 5 to 10% seller notes was pretty kind of commonplace back then, in those kind of lending situations when the SBA was involved. It wasn't uncommon for a seller note to be involved. So I think we're kind of getting back to a normalized status, rather than what I would say the anomalous status of 3% interest rate that was going on during kind of the pandemic. As far as the other point I wanted to bring up from Scott's talk is leases, and from a attorney's perspective, this is a kind of an evergreen issue, right? It's always, whenever there's a lease involved, buyers and sellers, to some part, I always advise people is, hey, this is as soon as it's practical, right? Whether if you're from a buyer's perspective where you've done, you feel comfortable with the deal and you want to move forward, and from a seller's perspective of, okay, I feel comfortable with this buyer, the sooner you get that landlord involved, the better off you're going to be, because that's what you don't want to do. Is you don't want to leave that piece for, okay, we're closing in a week, now it's time to get the lease assignment. And then, the landlord becomes difficult, right? Or, they're out of, it could be a situation where they're not necessarily difficult, they're just out of town, or, you're dealing with a mom and pop and it takes longer for them to kind of get the wheels turning versus someone else who might have, assignment documents together and ready to go and things like that. So whenever you're
let me just add a clarification onto that. David's 100% correct. You want to get the landlord involved as early as possible, provided, however, that the buyer has already received their commitment letter from their lender, like Scott at Dogwood, and that due diligence has primarily been completed. We're not signing a letter of intent and the next day making an introduction to the landlord. So, if the average time takes somewhere between 50 and say 75 days to do an SBA deal, and the commitment letters are typically coming within 30 days, it's probably after that commitment letter in that day to 30 to 35, maybe 40, when the majority of due diligence is done, that is when the landlord introduction. So you still have 30 days, but it's not a week before, as David pointed out. So I just wanted to clarify that. So David, keep going. What else are you seeing out there?
Yeah. And so sliding kind of away from what Scott was talking about into my stuff, I am seeing kind of much longer diligence periods from buyers, right? I mean, that's the biggest difference from when it was, okay, we're going to try to close in 45 days and we're going to have a 20 to 30 day due diligence and then a 15 to 20 day rush to close. I mean, you're seeing a good 2 months of diligence, I think, is fairly common in most of the deals that I'm doing.
Mhm.
I mean, I have one that, we've kind of been involved since late November. And, it's kind of with a floating diligence period that's run through kind of the end of January. Another one, and this is a little bit more, I would say not kind of, it's a strategic deal and it's a bigger deal. But it's kind of drug on we're in our second LOI, that the first one was drafted and processed in August, and they've kind of gone through an adjustment of the deal. The price is pretty much the same, but it's been a extremely long kind of diligence period, almost 6 months, and now they've kind of reaffirmed kind of the original deal points, and are going through with the purchase documents. But my gut is, and this is from me kind of being, not necessarily in the business side of it, but my gut is this was definitely a feeling out if we were going to hit kind of a recession type situation where both sides were like, well, what are we going to do? Do we want to get into this too soon? But I would say that diligence, where people feel on shaky ground, that diligence is still being extended due to that. And just what I've seen a bunch, and when we're talking about deals are still getting done, external deals are still getting done. I think I'm starting to see a lot of kind of internal deals, right? Where hey, we don't necessarily want to take this out to market. We want to sell this to a key employee. If you're a buyer, that means maybe you need to get potentially more aggressive with your offers, or do some, and that kind of stinks for buyers because stuff's not making it to market on those, right? Where there's an internal deal, we're going to keep it this way, or it's going to be kind of a longer kind of lead out for that principal member, as they kind of transition through, rather than a payout over one time. So I mean, I feel like I've seen many more kind of internal deals, and I don't know if that's just as a nature of some global type of perspective of, okay, this will allow us to kind of keep more control over the deal, as we don't know what kind of the external timeline is, or it just is happenstance that's kind of what I'm seeing. The other one is kind of along the lines that due diligence is kind of on the backside, is the transition periods, right? Those are kind of starting, I feel like, are getting stretched further, where when the rates were lower, hey, it's 30 days and sellers out the door, or 60 days and sellers out the door. Okay, well, we want this person around for 4 months, for 6 months. So we can contend with, we want to make sure that all these clients are locked up, all these vendors, all these relationships are solid and in place going forward. So I've definitely seen that kind of longer transition period pop up in these current deals. And then I mean, that's kind of the main ones. And then you're starting to get, again, like I was just saying, I mean, you're starting to see more requests for seller financing. You're starting to see kind of, again, less, trying to get alternative ways to kind of reach approved purchase points, but maybe not necessarily have it as all cash kind of transactions as we were seeing, the past couple of years, where it was just, hey, you're going to get paid up 100%. We got financing, and we're going to kind of move on, and we'll move out and and seller's going to be out of the door in 30 days. So it's definitely much more kind of probing and I don't want to say reticent, but everyone, it seems like there's a little bit more of just, hey, everyone's kind of taking their time on the front side and then on the back side in the transition as well.
Great. Well, lots of things to cover there. And we're going to come back to you, Scott, now that you're back on here. And we got a couple questions both on the same topic. I'll let you address these, Scott, and then you can bring up any other points that you have. And both of the questions are about terms, and Scott's not necessarily going to be specific here, but the first question is, are seller notes typically at favorable interest rate versus prime or SBA? And the second one is, just how are overall financing terms, going on right now in the market? Is the split more upfront, more seller financing? Just Scott, if you want to address sort of the makeup, and then add your comments about seller note rates, and I'm happy to add, and then anything else you wanted to add from getting cut off before, Scott.
Sure. I apologize, everybody. My technology is not my strong suit. I do very well at SBA loans. So
correct.
That's my commercial.
True.
Okay. I'm back. So first let's talk about the additional, seller notes and how those could be structured. So there are some parameters that SBA provides to the lenders, right? And that's called an SOP. And one of the items in the SOP is that the seller note, if it's going to have an interest rate tied to it, should not be higher than the SBA loan rate that the client is getting to purchase the business. So the way that those rates are set by lenders, and they can vary, but the SOP states that the lender uses the Wall Street Journal prime rate. That's currently 7.75% today. Those rates can adjust every calendar quarter. If it's a 10-year loan with SBA, there's no prepayment penalty on that loan. If there's a real estate component along with the purchase of the business, it can go as high as 25 years and would have a 3-year prepayment penalty. So currently, lenders are to not index. Our index over prime cannot be higher than 3%. So today's rate would be 10 3/4. That index over prime is going to vary by lender to lender. It's going to have to do with really the transaction. What type of business is it? What is the collateral that's being pledged for the business? What's the strength of the cash flow of that business? The stronger the cash flow, the more comfortable the lender gets. Generally, we're going to lower that index over prime. So I hope that addresses it. Each lender is going to handle those things specifically with you as a customer. But those secondary notes that are being held either on, if it's on standby, it still can accrue interest. The rate of that should not be higher than the SBA loan rate. And typically from my side of the desk, they've been lower.
Okay.
Think we addressed it?
Yeah.
Okay. Something that David had talked about was internal deals, and that just sparked something for me because lately I've had quite a few internal deals, and those are usually good transactions. But one thing I would note, and maybe a commercial for the business intermediaries of the world out there, is the deal goes much smoother with a business broker or business intermediary being involved, even if it is a key employee buying the business from a retiring owner. It just keeps, there's only a certain amount that me as a lender is going to get involved talking to both sides of the transaction. And it's good to have somebody in the middle of that to rely on to get things done, keep them on track, and those deals go much smoother. Not to say we wouldn't finance a deal that comes across our desk where there is not one, but in my experience, the transaction goes much smoother.
And the three of us worked on an internal deal where David handled the legal and Scott handled the financing, and I handled the seller who wanted to sell to an internal employee. So, and I agree. I'm going to stand up for all the intermediaries out there. deals go smoother with a qualified and experienced intermediary. Scott, anything else from a lender's perspective before we scoot on to some other things?
Yeah, I know. Yeah, I'll go quick on these. I know I dropped, but one of the things is, I hear from clients or prospective buyers, customers, whatever you want to call them, coming in that, they've talked to other lenders and they have shut down on a certain industry. And I hear that a lot, and it certainly happens, right? And from a credit perspective, but here in our SBA loan group, we like to talk more about, does the deal make sense? So everything's a case-by-case basis. We don't base it on past histories of industries. We're looking at this deal on its merits, right, to see if it's a pass or a fail for us. So right now, we're currently open to all industries, but I do hear that a lot. So that's something that folks on the line should be taking into consideration when they're talking to a lender. Find out if there's a list of certain industries that they just are hands off for them, and that just could be from their past portfolio. Personal net worth, just real quick, when a lender is talking about that, what are we looking at? We're looking at liquid funds. We're looking at cash, savings, marketable series, stocks that you could sell and liquidate immediate, not retirement, not 401k, 403b. That's your liquid portion. And then, of course, we look at retirement plans as a fallback. As we all know, a lot of individuals over the last year plus have taken a pretty significant hit in their personal net worth on the liquid side, on retirement plans, marketable securities. So this could limit, the size of the deal that the prospective buyer should be looking at. Is it $1 million business, a $2 million business, or a $500,000 business? So, each lender is going to have some parameters around your net worth. And the way that I look at the net worth is I'm first looking at the funds that you're putting into the transaction to get it done. That might be your 5 or 10%. And then what do you have left over? And a good rule of thumb is that you want to have about 6 months of personal liquidity on standby when you close the loan. So that would be your mortgages, your car payments, credit card bills, any other things that you're paying for. Just calculate that out. And that's what the lender is going to look for, that is on standby. And that's just a good cushion for unforeseen things, for interest rates. We had COVID a couple of years ago, right? Those things just happen. So there needs to be a source for you to continue to operate the business. So just a little piece on that. And then last is I'm seeing personally a significant amount of deals that the buyers are sourcing to multiple lenders. I get it. Competition is fair. But that brings challenges where it's creating much longer timeline, and that's for everybody involved. And there's a lot of emotions in these deals. And on the other end, you have somebody that wants to retire, sell the business, and exit. And now the due diligence and everything is just being pushed out. Now you're competing with other lenders. I will just say SBA is pretty cookie cutter program, right? The lenders that do the volume have to stick to the rules that were set forth. And it's really going to come down to the credit decision on that industry and then you as an individual. So what I would do is I would be looking, depending on the state you're buying the business in, you can go to SBA's website and the resources are there. You can pull up a list of all the lenders in the area that are producing SBA loans. It'll have their dollar volume, how many loans they've closed. And if I'm buying $1 million business, I'm looking for the lender that's doing a higher average loan amount, maybe $1 million loan, because that seems to be their wheelhouse versus a lender that's doing $75,000 SBA loans, right? They're probably not in the acquisition business. They're doing small equipment loans and things like that. So that's one way you can kind of source those before you just kind of shotgun it out to multiple people, is do some due diligence on the lender, see who they are. Are they an active SBA lender, or do they do a couple loans a year? And then that should help you guide to, who you should be working with.
And I'll just add
to it from my side.
Scott, I'll just add to that. There's something called a preferred lender, a PLP lender. If you're talking, look, you can use whatever lender you want and wherever you get the best rate, best terms. But if they're not a preferred lender, you're talking about tripling the length. If it's 30 or 40, 60 days, you could be looking at 4 to 6 months, because preferred lenders don't have the ability to sign off on their own loans. So we only work with preferred lenders. So if you are not working with a preferred lender, you're not going to get the best level of service. So I cannot stress that enough. You really need to. I understand it's a competitive market, and Scott and other good lenders out there that we work with, they're gonna win some deals, and they're not gonna win every deal. But you should. At what point, Scott, should they be committing to a lender? Say it's $1 million deal, and they've got a letter of intent, and obviously, are you saying that people are going down multiple lenders to try to get a commitment letter and then still holding? Because I haven't seen this, but you obviously see more. So just want to clarify on that.
Yeah, we've seen both. So the standard, every lender is going to have a different way that they process their SBA loan. So we are a preferred lender, as Adam just said. And what that means to you as a customer is we can make the credit decision. We act upon as the SBA. And all that SBA really will know later on in the process is electronically we get a loan number for you to close. We make the credit decision, we underwrite the loan, we close the loan, we service the loan. There are lenders out there that are not preferred lenders. So what they have to do is actually package the loan, all the financials, the credit, everything that's needed from an underwriter, and submit that to the actual SBA agency for approval. It could be a long, tedious process. Depending on the time of year, whether they're in session or not in session, so it is really a difficult process for that, and that is not your active volume lenders. They're just maybe doing a one-off transaction that came across their desk. I'm seeing both. I'm seeing in my process is, we like to get the basic information in to pre-qualify the deal. So we're pre-qualifying the buyer along with the prospective business to see if how that looks. At that point, I'm discussing with the client exactly what they need to know about the rest of the process, including what the terms look like of the SBA loan and the chances we'll get approval. Generally, within a week of that conversation, we've issued a term sheet to kind of outline that. We have the borrower execute that, and then we want to move the file to underwriting. We may have to gather just some additional documents to get into underwriting, but our objective is usually a 7 to 10 business day turnaround for a commitment letter. And then from that point, we work on the closing side of things.
Great.
I hope that addressed it.
I appreciate that very clear answer, Scott. It's really important to know the difference between a preferred lender and a non-preferred lender. Before we jump into sort of the broker's perspective, we got one more question in here, and this is pertaining to you, Scott. Is a potential ROBS rollover, which is where you're using your retirement funds, considered by the lender in the liquidity conversation? How do you look at a ROBS rollover?
Yeah, it's very common. Last 10 years plus, done a lot of transaction with a ROBS, or what they call an ERISA rollover, where you can roll over your retirement funds into the business that would be set up as a C corporation. I'm not an expert on that. There are some great experts out there. You can find them all on Google that set those up for a living, including attorneys. But it's a great way to get that injection into the business without giving up your personal liquidity, whether that be cash or marketable securities. So once the way that we look at it, though, in underwriting is once that injection goes out of the retirement, essentially on paper, it doesn't exist anymore as liquidity, because you've now just put that money into the business, right? And that is the note that's there that provided the equity to get the SBA loan. So we know that it can come out of the ROBS down the road and go back to retirement, but we don't look at that. We would look at it as the money has been exhausted. It's gone out the door. It's been spent towards the purchase. But we also don't look at retirement as a liquid item. right? Because we all know with retirement, you have to cash it out. It takes time to do that. You're going to take a tax hit on that money. So, we don't really look at retirement as the fallback all the time for personal net worth. So I think we answered that as, once those funds are being rolled over, those funds are no longer in your personal side, right? They've now moved to the C corporation, which is another asset to you.
Great.
And I was actually going to mention something about Rob's, and I can't remember how I was going to play it into what we had previously asked, but since it's up, for me as kind of continuing attorney going forward, the one thing that I would want anyone who was considering using a Rob's to kind of fund a business purchase is what you absolutely need to be thinking is how you're going to get out of that. Once you buy the business, because your ability to kind of get funds out of that once the Rob's is in place, and once you have this kind of 401k kind of owner of a business, because that's kind of how this thing gets set up. There are certain limitations of things you can do related to distributions and things like that, that are going to be subject to kind of the ERISA guidelines, all the way up to potentially selling your business, right? So you're going to be tied to that, paying back into that retirement fund some set amount of ownership, depending on how much of that ownership is owned by that ERISA account or the 401k account. So like it's all, whenever I have a client who does it, and again, as Scott said, it's a great way to kind of use money that's kind of tied up to purchase a business so you can go forward. But again, it's always something where, potentially as a buyer, you need to figure out what your next play is, or how to potentially get out of that, somewhere down the line. Because if you do not do it before the time you sell, then you are going to have to dump money back into that 401k in that percentage, and you can't really take preferred distributions or anything like that for you individually versus undercutting that 401k. So that's just something to think about. It is a good way to do it, but once you're into it, you need to kind of start thinking about, how am I going to get out of this, and how am I going to kind of fund that 401k back so you can continue to grow the business and not be hindered by that ERISA account somewhere down the line.
Yeah, and we were supposed to have a provider last year, and they had to cancel. So this whole conversation is reminding me that maybe I'll do a specific webinar talking about how to utilize retirement funds for the purchase of a business, because it's a viable option. But to David's very simplistic legal commentary, if you don't do it right, you are going to get screwed.
Right.
So there's a lot of great advantages, but it really has to be done properly. So let me sort of jump into a couple of, from my seat, a broker's perspective, some things that we're seeing. I just want to touch, sort of things that both David and Scott have addressed, which is deals are absolutely getting done. I mean, our third and fourth quarter, we're very busy. We're off to a very busy start again this year. Deals are getting done. Due diligence is taking longer, and lease challenges are real. And so, all three of us have said it, so odds are pretty good that it really is happening. The number one thing that I would say out there is I still see most buyers who want to buy a business just are not prepared. They're not ready. And the reason why they're not ready, or the definition of not being ready, is they haven't talked with a lender like Scott to get pre-qualified, to know how much the bank will back them, or they haven't had the conversation, or they're not liquid. They haven't had a conversation with a spouse to be ready to move. Because when businesses come out today, if they're good businesses, they're going to be, it's like a house today. Houses are still selling just fine. So businesses are are very similar. We are still not back to pre-COVID levels of the amount of business inventory out there. And I can't stress to you enough that if you're not ready with a pre-qual letter from an SBA lender, you're just not going to win a good engagement when it's coming out, because there's so many other people that are doing that, that are prepared, that are ready to act when a good business comes out. Now, I'm not saying deals are going in 1 day or 3 days, but it's weeks, not months. Now, yes, not all deal, but we just put one out recently and we had several offers within the first 10 days and it's already under agreement. So it is happening out there. So buyers still need to be prepared. They need to get pre-qualified. The other thing I would say to buyers is good businesses are not selling at a discount right now. Some are, everything's situational, but you should not assume that if a business is listed at $1 million, because there's high interest rates and other things going on, that you can go in there and offer $750,000. You are more than welcome to do that. I will tell you the odds are stacked against you that you're going to be successful with that approach. If you're working with a seller and they're represented by an intermediary that has a good understanding, good experience, good training, brokers are pricing those businesses to sell. And good businesses, like I just got done saying, there's not, hundreds of them just sitting on there in your local market. So if you see a business that is $1 million or $2 million or 750 or 2.5 million or whatever the number is, and you like it, you got to be ready. You got to be ready with pre-qual. You got to be ready. And I would say odds are, be prepared to pay, just below, at, or even above what is being offered. Don't come in 25, 30, 40% below. It won't get the deal done. The other thing that I'd like to just sort of remind both buyers and sellers, we touched on this earlier, is 2020 at this point is essentially out of the discussion and out of the picture. Everyone knows what happened 2020. Banks and valuation firms that are all required to get an SBA loan, they're essentially not even paying attention to 2020. It's how'd you do in 21, and really, most importantly, how'd you do to 2022? Now, the downside of that is if you have not recovered back to pre-COVID, then your value will be damaged, and then lenders and valuation firms will be looking at things in 2020 and 2019 and the other. The second thing that I've seen, or another thing related to back numbers, is we've gotten a few requests for people to say, oh, well, we want to see your 2006, 7, 8, and 9 tax returns. Because 6 months ago, or 3 months ago, everyone's screaming, oh, we're getting a recession. Well, the economy's proved A, more resilient, and B, most people don't have their tax returns from 14 years ago. And so we've had buyers walk away because we can't produce 2007 and 08 and 09. Well, the seller's not legally required to have those anymore. And so, just keep that in mind. We understand you're doing your stress testing, but part of due diligence, yes, it's expanding and it's taking longer, but I would also say you also have to make sure your due diligence requests are reasonable. The last thing that I would say is that, sellers are continuing to assume that these are quick and easy, and buyers are assuming that it's a buyer's market. And I think both of them are wrong. As we all said, deals are taking a little longer, but they're getting done. And there's also not the amount of inventory that would swing this to a buyer's market. If we bring out a good business today for $1.5 million, we're going to have inquiries on it pretty quickly. And that's just not us. That's brokers all across the country in all types of industries. So it goes back to my other theme, which is you got to be ready. Good businesses continue to sell. They're selling, relatively orderly. I don't want to say quick because I don't like to promise anything, but the average business transaction takes about 9-10 months from when you go to market. And so, yes, do we sell some in 36, 30, put them under contract in 30 days and close 60 days later? Yeah. But the reality is the average still remains around 9, 10 months. So some are going quicker and some are going longer. And so keep that in mind. The last thing that I would say is I would argue that now more than ever, you need a team of advisors around you. Because of interest rates that Scott talked about, because of due diligence issues that David talked about, because of some of the issues that I talked about relative to handling leases, buyers and sellers need a team around them, a good financial advisor, a good CPA, a good transaction attorney, not just an attorney, a transaction attorney like David, and a good lender like Scott. And obviously, a good broker like our team here. Everyone's busy. We're all experienced. We can help get deals done. And I can't stress enough that it really does take a team to get deals done, more so today than 18, 24 months ago when things maybe went a little quicker, a little smoother. We did just get a question here. I'm going to answer this live here. I'll open, Scott, I'm going to let you take this. Is there a typical valuation across small business, or is it highly varied based on a type of business, 2 times or 4 times cash flow or any other multiple? Scott, I know the answer is it depends. A good intermediary should be able to share with you transaction data. We all subscribe to private databases that are not publicly available. There are industry-specific multiples, but Scott, do you want to address that question?
Yeah, I will. And as you were just mentioning, and I think they mentioned in their question, it can vary for sure. We know there's different multiples on different types of businesses and the way that they're evaluated. Now, each lender is required to have a third party conduct that evaluation. So we cannot accept a valuation from somebody that did it on their desktop or is not an accredited valuation expert. So that is a requirement and a designation that they have to have. So most of your lenders will have multiple, what we call third-party resources that we will, submit that to at the appropriate time to get a valuation done. They typically cost around $2,500, and we usually get about a 2-week turnaround time for that report to land on our desk. Now, a good rule of thumb that we probably would use, I would use, or I've been using most of my career is, we do have some databases that we subscribe to that will give us some guidance if it's, an industry that we hadn't really seen before or hadn't lent to a lot, or some of our credit team doesn't have experience with, and just to see if we're on the right track. But we typically will look at, the seller discretionary earnings, which is of course, the income of the business plus add backs, which would be owner's compensation or other items. And we will use about a 3.5% multiple of that just to get started to see if we're in the right, vicinity. I will tell you, anybody folks on the phone, I've had transactions come across my desk where the valuation is a 10 or 15 multiple. I've been doing this 25 years. I've never closed an SBA loan that's had a 10 or 15 multiple. So, to us, that just doesn't seem like it's realistic and it's going to happen. And I think they have the price of, we really don't care if we sell it right now price. But that's just my candid opinion on that. So I hope I addressed it. That's how we do it. So again, though, we do have some resources we can lean on if it's a very, interesting industry that we don't have a lot of, we haven't done loans for before. But in our team, we have a very seasoned group that have been in the SBA lending business over 30 years. So we always say we've seen just about everything. So we have a pretty good idea, or at least can get the answers internally quickly on if this is something that looks realistic or not.
Yeah, it's a great point. And just last comment on valuation before we summarize and end this webinar today. A little secret out there that I'm not picking on the industry, but let's just say the HVAC industry. And I'm talking about maybe a cash flow SDE of, $3 or $4, maybe $500,000. And I know HVAC has been very popular in a post-COVID era, but multiples really haven't changed much in small business significantly. I'm not saying there aren't certain industries or in margins or, maybe there's a competitive environment, but you're not seeing an HVAC business go from, and I'm making these numbers up here, 2.75 times seller's discretionary earnings. And now all of a sudden it's at, the same 400,000 SDE. Now it's trading for 5.5 times. It just isn't happening. The math doesn't work either. And the math has to work or else the lenders won't underwrite it. So there is some movement, but it's not multiples aren't doubling or tripling out there like some people think. When you get into some of the $100 million deals, that's different. Multiples are moving 20, 30% in a year. In fact, at the higher level, deals absolutely peaked in Q3 and Q4 of 2021 and started to come down in 2022. Small business markets under 5, they're relatively constant with some variability based on the industry. So let's bring it home here, guys. Summary, again, we've all said it. Deals are absolutely getting done. We all remain very busy. We're all working on plenty of deals right now. Due diligence is taking a little longer. Deals are taking a little longer. Rates have, I would say, impacted deals, but it's not stopping them. Advisors are more important than ever. As we talked about, 2020 is less relevant, and lease issues are real. It's part of the reason why everyone in my office are real estate brokers. You need to know what you're doing. If you're a buyer and you're not using someone with real estate license, you are not being served in the best manner. If you don't have a license, you should be getting someone involved. These are real estate transactions, and landlords today are absolutely using backbone. They're not as tolerant as they were 3-4 years ago because they can get the rates. So for the manufacturing company that's been in a lease for 10 years, as Scott alluded to earlier, that lease rate could go up 30-40%. And so the lender has to make sure that the cash flow still works, and the broker should have done that work up in advance as well, because those are real numbers. They're coming directly out of cash flow. And obviously, Scott mentioned some banks are looking at things with a little more scrutiny. Certain industries, obviously, a couple of years ago, no one would touch the restaurant industry. I think that's starting to recover significantly as we all, get back to a normal life here and eating out. But, they're still lending. We have one more question here. This is my last call for questions here. Actually, no, it's not a question. It's a thank you. And so really appreciate, David, your time, Scott, your time. Our job on these webinars is really to inform so you can make the best decision, whether you're a buyer, whether you're a seller, whether you're an advisor who's working with a buyer or seller. We want you to make the best decision for your future when you make that decision, when you decide to buy or sell. And then finally, I'll just leave it. Here is all of our contact information. And this will be available on our website over the next 24 hours. You will get a follow-up email if you've attended this. If you're seeing this on a recorded, you can still reach out to basis. You can reach out to any one of us here. We look forward to helping with you as you go through this process and help you make the right decision when you are ready. So David, thank you. Scott, thank you. And for everyone who's been with us today, we appreciate your time, and we are available to help you and wish you all the best of luck.